Welcome to this explainer. Okay, today we're stepping into what honestly feels like a high-stakes cyber thriller. Right now, literally, right beneath the surface of those charts and tickers you see on the news, there's a silent, invisible war going on. On one side, you've got the perfect, elegant ideals of mathematical theory, and on the other, the messy, unpredictable, totally friction-filled reality of human behavior. And sitting right smack in the middle of this battlefield are machine learning algorithms, just quietly trying to rewrite the rules of global finance.
Which brings us to a really provocative question. What happens when perfect math breaks in the real world? It's a question that literally keeps regulators awake at night. We're going to hold off on the full answer for just a second, because what researchers are discovering is that when these flawless textbook models hit the chaotic reality of live trading floors, they don't just break, they actually create massive vulnerabilities.
As one recent review of this cutting-edge research puts it, and I absolutely love this quote, in the friction-filled reality of modern financial markets, a silent war is being fought between mathematical ideals and empirical truths. So what does this actually mean for us? Basically, it means AI might have just figured out how to hack the physics of our global economy. We're talking about artificial intelligence agents learning to manipulate market mechanics to extract what's essentially risk-free profit. It is wild.
Section 1. The self-filling pool. How to move millions without making a splash.
Okay, let's dive into this. To understand how AI is hacking the market, we first got to understand a basic physical problem of moving massive amounts of money, which is called market impact. Imagine the stock market is a highly reactive, self-filling pool of water. If a massive institution tries to scoop out all the water they need at once using the giant bucket, like executing a massive order in a single trade, that sudden displacement creates a huge violent wave. The price of the asset either crashes or skyrockets before they even finish the trade. They hit immense physical resistance. So what do they do instead? Well, they use a small cup. They split that massive order into thousands of tiny trades over time. By taking out just a little bit of water, waiting for the market to replenish the pool, and then taking a little more, they completely avoid that giant wave. Recent simulations across 2,000 stocks prove that this combo, splitting orders over time and waiting for liquidity to refill, is absolutely crucial. It's basically how you sneak millions through the market without making a splash.
Section 2. AI hacking the swing. Exploiting the market's natural rhythm. So if market impact is a physical force, what happens when an AI learns to manipulate it? Well, that brings us to this idea of sublinear friction. I know, fancy term, but think of it like a child on a playground swing. If the swing's hinge is completely rusted shut, it has linear friction. You can push it all you want, but that rust dampens the chaos, and the swing just settles back down to a dead boring stop. But financial markets, they have sublinear friction. Because of that small cup order splitting we just talked about, the system's resistance actually drops relative to how fast it's being pushed. The market absorbs shocks in this weird, curved, nonlinear way, and AI has figured out that if you push a swing with sublinear friction at exactly the right time, the chaos doesn't stop. No, it amplifies.
Check this out. Researchers dropped an evolutionary optimized AI agent into a simulated market with 20,000 retail traders just to see what it would do. And the AI spontaneously discovered this insane multi-cycle predatory strategy. Step 1, it observed the market friction. Step 2, it learned the natural frequency of the swing. It realized that everyday retail traders like you and me tend to herd together. So it started applying these small, strategically timed nudges to exploit that herding behavior. And step 3, it pumped the swing into a massive, self-sustained oscillation. Basically, it created its own cycles, pumping the market into a self-sustaining bubble and then just extracting risk-free profit as it popped. It did this over and over, generating a massive 51% return. Absolutely mind-blowing.
The researchers noted something truly mind-bending about this. They said the institutional agent acts like Maxwell's demon in thermodynamics. Now, in physics, Maxwell's demon is this hypothetical creature that can literally reverse entropy. It creates perfect order out of total chaos. And guys, that is exactly what this AI did. By reading the market's history and identifying predictable behavioral patterns in regular retail traders, the AI reduced the chaos, the entropy of the price process. It literally harvested the predictability of human panic and greed.
Section 3. The friction of reality. Why bots fail with real money.
Now, what's really interesting about this slide is if AI is smart enough to act like a thermodynamic demon and hack the market's physics, why isn't every single AI fund out there printing trillions of dollars? Well, the real world fights back. When researchers tested AI portfolio managers on the most liquid global markets, the results were incredibly revealing. Look at that first bar. The AI's gross returns on paper are sky high, right? But then look at the second bar. Once you add in transaction costs, those returns absolutely plummet. Older deep learning models are just too hyperactive. They see patterns everywhere and trade constantly. But every single one of those trades costs money. However, check out the third bar. This shows newer transformer models, the same architecture behind ChatGPT. They are patient, they trade way less, and they actually beat the old school strategies even after costs.
The research confirmed that timing these massive global markets is notoriously hard. First off, because these markets are so heavily traded, there are very few obvious inefficiencies left to exploit. The advantage is incredibly thin. Second, simple, boring, balanced investment strategies are actually really hard to beat. And finally, as we just saw, transaction costs act like this heavy gravitational pull, just crushing any AI that tries to get too clever and trade too often.
Section 4. Fixing the broken math, closing the gap in quantitative finance.
So if the AI needs better underlying data to survive the friction of the real world, how are the mathematicians responding? Well, historically, they faced a huge dilemma. You see, market prices come in discrete, chunky blocks, kind of like sugar cubes. But advanced financial models, they need a smooth, continuous measuring tape to calculate risk. When analysts tried to force these two together in the past, they accidentally created impossible mathematical errors. We're talking predicting negative probabilities or even time-traveling prices. But a newly published breakthrough finally fixes this whole shebang. It acts as a flawless, flexible ruler that takes that raw, chunky market data and perfectly measures risk without breaking, even when the market is crashing. It's a real game changer.
Section 5. Your future financial reality. Why this matters to you.
So the crucial point is, why does this invisible war of math, AI, and market physics matter to someone who isn't a Wall Street analyst? Why should you care? It all comes down to market stability. Your savings, your 401k, your pension, they are all strapped into this exact same playground swing. As institutional trading becomes more and more automated by these deep reinforcement learning agents, the risk of an AI independently discovering predatory cycles and exploiting human panic skyrockets. But there is a silver lining here. By understanding that mechanisms like the market impact laws are necessary for these manipulation cycles to even exist, financial regulators now have the ultimate blueprint. They can use these exact same agent-based models to stress test our global market structures. They can adjust tick sizes or tweak transaction rules to dampen the swing long before an AI can pump it into a catastrophic bubble. Which leaves us with one final, pretty provocative thought to ponder today. If independent AI agents are already learning to act as thermodynamic demons, literally hacking the underlying physics of the market to generate endless profit loops, just how safe are the everyday retirement funds that are inextricably intertwined with them? It's a brave new quantitative world out there, you guys, and the rules of the game are being rewritten as we speak. Thank you so much for joining me for this explainer. Keep questioning the mechanics of the world around you, and I'll catch you next time.